Hello and welcome to Portfolio Matters. This short podcast, we will be talking about where we are in the business cycle and in the equity market cycle. But before we get into it, Richard will read the disclaimer.
Discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. Okay, now we do weekly updates on Portfolio Matters, and that is very interesting, and we hope you enjoy them, but it does make us have quite a short-term outlook on markets. I end up looking at my portfolio far more often than actually I probably should. And so I think it's useful to occasionally step back and take an overview of where we are, both in the business cycle and in the equity cycle, and decide what our allocation to equities should be and to other asset classes. And so that is our aim today. Okay, so this is the clock of the business cycle that we use occasionally, and we have definitely troughed. Growth is returning, but there are various impediments to growth continuing as a hangover of the COVID restrictions, both in the UK and the US. And I think we remain very much at the start of the business cycle, which should last years. Richard, what are your thoughts?
Yeah, I think we probably are, Keith. You're right. And certainly we've had a very strong rebound post-COVID in all the developed economies. The question marks that I have are, as we discussed at the end of our podcast earlier today, what's going on with small businesses, and I think that remains to be elucidated. And the other question is, given the unprecedented nature of financial support that economies have had, when that support starts to be withdrawn, what effect does that have on the length and height, if you like, of the business cycle?
Absolutely. But I think all we can do is say where we are right now. Now, I share your concerns about how long this business cycle will last. Now, the last few business cycles have actually been very long. And I wonder whether we will see that pattern or we'll go back to more historic norms where actually the business cycles tend to be quite short. Do you see the expansion phase only lasting 3 or 4 years at most?
Yeah. Well, one of the things I think that has changed is central banks have been much more prepared to step in and support perhaps a rather old business cycle to keep it going, lengthening it, but actually then finding that the recession is all the more painful and getting themselves into a little bit of a pickle in terms of how do they now get out of doing that.
The next chart comes from a book I've been reading, which is called The Long Goodbye by Peter Oppenheimer, as detailed of the source here on the bottom of the chart. Now, this is the equity market cycle as described by Goldman Sachs. So this comes from a Goldman Sachs piece, and I've attempted to recreate it with a few tweaks. And they have the equity cycle in 4 phases. And I like the way they've done this. And I thought this was quite useful. So starting with phase 1, despair. This is a bear market. And that's when the economy goes into recession or equities being overvalued. There's a big fall in the equity market. And that generally is quite short in duration.
And history tells us, Keith, that the point where we should be making most of our investments is at about 5 to 12.
Yes, very good point. So the next phase, phase 2, is hope. And that is when the equity market turns up strongly before the turn up in corporate earnings. So the market is anticipating a change in the business cycle leading to future strong earnings growth, but that is typically 6 months before any upturn in corporate earnings growth. And that is the phase where you see the strongest equity market returns. And I think we are now past that phase in this current equity cycle. So the next cycle is then growth. And this is when corporate earnings start to catch up with and perhaps disappoint the heightened earnings expectations out of phase 2. So equity investors have been anticipating a strong upturn in corporate earnings. And then in phase 3, real numbers start to come in, and perhaps they're not as strong as everyone hoped. And so the growth phase lasts years. And this is the main phase of the business cycle. And so during that phase, actually, and we will see the numbers shortly, equity returns tend to be indifferent. They're okay, they're positive, but they're nowhere near as strong as in the hope phase. And then the final phase, phase 4, is when towards the end of the business cycle, we have had good business conditions for a few years, everyone has made money, and that starts to feed on itself. You get an upsurge in optimism and very strong earnings growth leading to greater expectations. The stock market starts to surge again until expectations get ahead of reality, and at some stage it breaks and you lead back into despair and the cycle starts again.
So can I make a comment on that, Keith? Sure. I think that's really interesting, actually, very, very nicely displayed. One of the confounding factors is interest rates. And of course, PE multiples are basically a calculation of the expected future return based upon the discount rate being the risk-free rate. And what we have seen over the last few years is a continual reduction in the risk-free rate. And that has been feeding into increasing PE multiples.
Yes.
So all of this PE multiple change needs to be interpreted understanding the background of the risk-free interest rate.
Yes, I agree with that, Richard. So this is a single factor, and you're talking about is interest rates are a separate but slightly related factor. And as growth returns, interest rates rise. So you'll have rising corporate earnings growth, but at the same time, rising interest rates, which should actually slightly counteract the effect of rising earnings. So this is my own imposition of those various phases of the equity cycle on the FTSE All-Share. And so you see in early 2020, we had a short, sharp despair phase as the world locked down from COVID. We then had the best part of a year of very strong growth in equity prices. So this table shows the annualized real returns during the 4 different phases of each equity cycle between 1973 and 2019. And what it shows is during the despair phase, the annualized return is terrible, an average of minus 44% and a median minus 40. Now, the despair phase tends to last between a year and 18 months. So you're talking about very serious shareholder value destruction during the despair phase. During the hope phase, which again does not last very long, you see very strong equity returns. annualized returns of 77%, median 69% average. But the hope phase does not last very long at all. You're talking less than a year in general. You get a sharp bounce back, and then you go into the growth phase. Now, bearing in mind what Richard has just said about the influence of interest rates and inflation, you'll notice that during the 1970s and up to 87, the growth phase actually lost money in real terms because inflation was high. And it's only since then that you've had sustained real positive returns during the growth phase, and even those have not been terribly high, frankly. So during the current phase, equities have a mildly positive expected return, and then towards the end of the cycle, as optimism comes in, you have once again very strong returns. Now, I would argue that in the last phase, we probably didn't have optimism, certainly in the UK, although in the US, there was. The tech had a very strong performance of tech companies. In the UK, we did not have a strong rise. And in the optimism phase, you have an average return of 48% and a median of 31%. So
interestingly, Keith, in the optimum phase, there are some quite low returns in there as well. 0, 2000, 2007, and then 20, 87 to 90.
Yeah, well, it really need the market to go into a phase of optimism. Sometimes it never quite reaches that.
Yeah.
I think the UK performance of the UK stock market in the last cycle would be indicative of that, frankly.
Yes.
Now, this is the performance of US Treasuries under the same regimes, and you can see that, and this is interesting, during periods of despair, actually, it's only in the last couple of cycles that it's had very strong positive returns. So we're talking about when inflation expectations are low. During the hope phase, it's actually had quite positive returns, although again, negative recently. And that to me indicates that there has been a change of conditions as we have come used to very low inflation. In the growth phase where we are now, don't hold bonds, basically. We are in a growth phase. Inflation should start to pick up. And then finally, in the optimism phase, once again, returns are positive. And I wonder whether that is some canny investors starting to anticipate that this is all going to end badly and buying into treasuries. What are your thoughts, Richard?
Well, I think it's quite interesting. Again, Keith, so what we know is that the interest rates have been on a long-term downtrend for the last 30 years. And if you look at the average return during those periods, you've got 1 for despair, 11 for hope, -2 for growth, and 9 for optimism. So effectively, what they're saying is that treasuries are continually giving a positive return, except for during the growth phase, and even that is marginal. So again, the issue here is, I think, what is a consequence of the long-term reduction in interest rates, and what is a consequence of the business cycle? And I think it's quite hard to tease the two out. But definitely, as you say, what you don't want to be doing is owning treasuries during the phase that we think we're now in, which is the growth phase.
Yeah, we are also, of course, relying on Peter Oppenheimer's characterization of the different phases of each cycle. And we don't know how he's done that. And in fact, we don't really know what he's done. And then finally, into commodities. This I thought was very interesting, because during the despair phase, commodities can do very well, which is completely counterintuitive and makes you wonder how he has characterized the different phases. But I'd also say it's because a rising oil price can induce a market crash. So, you know, in the 1970s, you had very strong commodity price rises, which were part of the reason that equities did badly.
It's also very volatile, is it? So they did despair phase, Keith. The returns are very volatile. Minus 38% and plus 362%. So the dispersion is huge.
Yeah. And then in the hope phase, again, very volatile. You see the growth phase is generally positive, but in recent years, last cycle, actually commodities did badly. And what we're once again, you are missing a variable here because it doesn't talk about the commodity cycle itself and how previous massive outperformance has led to great investment in commodities, and then that depresses returns going forward. But then in the optimism phase, commodities do very well.
Because just to remind viewers, this is the commodity prices overlaid on the equity cycle.
Yes, that's true. That's absolutely right. That's it. In summary, taking a step back and looking at the business cycle and the equity cycle, I think we are at the start of a new business cycle that could last for years. And that puts us in the growth phase, stage 3 of the equity market cycle. And the best returns for equities are now past. We will not see a return of the extraordinary performance, equity performance from last year until hopefully we get a bout of optimism towards the end of the cycle. So during this phase, be long equities, be long commodities.
And as you rightly said at the very end, Keith, ignore the noise.
Ignore the noise. So that's it. Thank you all for watching. Please, can you press subscribe and like? And in the meantime, it is goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.